The average return of the stock market is approximately 8%. This doesn't mean you will make 8% every year. Instead, with a diversified portfolio, you can expect 8% over time. What is a portfolio, however? A portfolio is just a collection of items. In our case, it's a collection of stocks and possibly other financial products. What is a stock then? A stock is just a small portion of a company. Let's say at a local farmer's market, you see a stand you like. You notice that the stand could use a new sign. So, you offer the stand owner some money to buy a new sign, and in exchange, you'll get a portion of the money that the stand makes. You are effectively a partial owner of the stand, and a stock is simply a partial ownership of a company. But why would a company or farmer want to sell part of their business? The money they can get can go towards new equipment, more advertising, or even to fund new projects. The farmer sold you part of her business, and with the money bought a new sign, which will help her get more customers. But now why would we want to invest? Well, prices rise as time goes on, in a process called inflation. This means you won't be able to buy the same thing in the future as you could today. Let's say a loaf of bread costs you $1 today and $1.10 in 1 year. That price increase is called inflation. However, as time goes on, investments on average will also go up. The stock market is considered an anti-inflationary tool. This means that when you invest, your money will increase in value more than inflation on average. How do I know my money will be safe? Stocks are considered highly volatile, especially in the short term. This is because stocks can react to the news, investors' feelings, and other temporary factors like earnings. However, the risk factor can be minimized in two ways. First, holding stocks for long periods of time will mitigate the impact of short-term price changes. When investors talk long-term, they can mean anywhere from 5 to 20 years. The price changes today or this month will not significantly impact where the stock price is in 10 years. Secondly, diversification is the key to minimizing risk in investing. But what is diversification? We have all heard the phrase, "don't put all your eggs in one basket." This statement rings true with investments because you don't want to lose everything if disaster strikes. Diversifying your stocks means to own a wide variety of them, not just one. But how does diversification work? If you only own one stock and bad news comes out about the company, you could lose all your money. However, if you own 30 different stocks, that one piece of bad news will have a much smaller effect. Additionally, it lowers how volatile your portfolio is, meaning your money will grow steadily without going up or down a lot on any given day. Stocks represent small ownership in a company. There are many reasons to invest in businesses, but the most practical for many of us is simply to make sure our money grows more than inflation. This doesn't mean we should take all our money and put it into one investment. We must diversify to protect our hard-earned money. Proper investing and diversification can be a great way to grow your wealth. And with good investments, $5,000 invested today could be worth $50,000 in 30 years without you doing any work. While investing might seem scary at first, it's actually riskier to not invest your money and let inflation lower the value of your dollar.